Demand for housing credit remains firm, which explains the ongoing high auction clearance rates. So, has the property market further to run? And what is the RBA likely to do? Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 12th of August 2017, our weekly digest of the latest finance and property news. Company results released this week included the full-year outcomes from the CBA, half-year from AMP, and third-quarter results from NAB. There was a common theme throughout them all. Mortgage loan growth has continued, and thanks to loan and deposit repricing, net interest margins have improved in recent months. This was also helped by more benign conditions in the international capital markets. In addition, overall provisions for bad loans were reduced, despite higher delinquency rates in the troubled Western Australian property market. We think the banks, overall, will continue to churn out larger profits as they use repricing to cover the extra regulatory costs and bank taxes. In fact, savers are taking a lot of the pain, especially on term deposits as rates fall even lower. And this gets less focus compared with all the commentary on mortgage interest rates. Mortgage brokers were in the news again this week, with NAB suggesting that changes do need to be made to improve the trust and confidence that consumers can have in brokers. UBS put out a research note suggesting that broker commissions will be trimmed soon, while CBA reported a fall in the volume of new mortgages sourced via brokers compared with their branch channels. We're beginning to see significantly differentiated distribution strategies amongst the banks, with some suggesting a migration to digital will reduce the importance of the branch, whilst other lenders like CBA are investing in new, smaller outlets, with the expectation of driving more business generation through them. In interesting timing, CBA, as a result of John Simond exercising his put option, is also buying the remaining 20% interest that they hold in Aussie home loans. RBA Governor Philip Lowe's opening statement to the House of Representatives Standing Committee on Economics contained a few gems. Globally, monetary policy stimulus may be reducing, whilst low wage growth, he says, is linked to a complex range of global factors from technology, competition, and the lack of security. Locally, business investment is still sluggish, and the RBA says households are adjusting to lower wage growth, plus rising power prices and the burden of heavy household debt. The RBA is still projecting 3% growth in the years ahead. The next move in the cash rate will be up, but not for some time yet. Now, 10 years ago this week, French bank BNP Paribas wrote a warning of the risks in the US securitized mortgage system, and later UK lender Northern Rock saw customers queuing to get their money from the bank, a reminder of what happens when confidence fails. Later still, Lehman Brothers crashed, and in the ensuing mayhem as banks fell from grace and were either left to die or were bailed out mostly with public funds, and mortgage arrears rocketed away in many Northern Hemisphere centres. Whilst much has changed and banks now hold more capital, we still think there are risks in the financial system. In fact, if the RBA does raise rates here, there is a risk we could have our own version of the GFC, because it was the sharp move up in mortgage rates that finally triggered the crash a decade ago. We have very high household debt, high home prices, flat income, rising living costs, and ultra-low but rising mortgage rates. We also have a construction boom with a large supply of new and speculative property, and banks that have around 60% of their assets in residential property. Arguably, lending standards are still too loose despite recent tightening, which, you should note, had been imposed on the lenders by the regulators. So the RBA will need to lift rates carefully to avoid a crash. Elsewhere, lending data from the ABS showed owner-occupied housing lending rose 0.5% in trend terms in the past month, or around 6% over the last year, well ahead of inflation. Lending for new construction rose. But lending for investment housing fell a little, down 0.85% month on month, despite ongoing strong demand from investors in Sydney and Melbourne. First-time buyers were more active in June. They made up 15% of transactions compared with 14% in May. Property demand is actually stronger than a couple of months ago, as confirmed by the still strong auction clearance rates. Other personal finance, though, fell 1.8%. The trend series for the value of commercial finance commitments rose 1.8%, and non-housing fixed lending rose 3%, whilst revolving credit rose 1.8%. So perhaps, finally, we see lending by business beginning to gain momentum. This is what is needed for sustainable growth. The ANZ job ads were also stronger in July, and the NAB business confidence indicators were also higher. All of this is pointing to stronger business investment, perhaps. On the other hand, the July DFA Household Finance Confidence Index was lower, with the average score down to 99.3 from 99.8 last month, and below the neutral setting. However, the average score masks significant differences across the dimensions of the survey. For example, younger households are considerably more negative compared with older groups. This is strongly linked with property owning status, with those renting well below the neutral setting, and more younger households rent these days, whilst older owner-occupied owners are significantly more positive. We also see a fall in the confidence of property investors relative to owner-occupied borrowers. Across the states, we see a small decline in confidence in New South Wales from a strong starting point, whilst in Victoria, households were more confident in July. The driver scorecard shows little change in job security expectations, but lower interest rates on deposits continue to hit savings. Households are more concerned about the level of debt they hold, as interest rate rises already in the system bite home. The impact of flat or falling incomes registers strongly, with more households saying in real terms they are worse off. Costs of living are rising fast, with the changes in energy prices, childcare costs and council rates all hitting hard. That said, the continued rises in home prices, especially in the eastern states, meant that net worth for households in these states rose again, which was not the case in Western Australia, the Northern Territories or South Australia. Sentiment in the property sector is clearly a major influence on how households are thinking and feeling about their finances. But the real dampening force is falling real incomes and rising costs. As a result, we still expect to see the index fall further as we move into spring, as more price hikes come through. And in addition, the raft of investor mortgage rate repricing will hit further, whilst rental returns remain muted. So overall, we see a very mixed picture, with demand for property remaining firm, lending still rising, income still under pressure, and lenders able to buttress their profits thanks to lifting margins. This puts pressure on the RBA, who continues to warn of the risks to households, but cannot lift rates very far. This tension will play out not just in the next few months, but over the next 2 to 3 years. And that's the property imperative to the 12th of August 2017. If you found this useful, do subscribe to get future updates and check back for the latest instalment. Thanks for watching.